emergency. State of the markets. It's an emergency. What's up, everybody? Spencer Israel, Jason Purrs, JC Perez. In that order on your screen. It is 2:31 on a Federal Reserve announcement day, which means we have to go live and talk about what the Fed just did or didn't do. In this case, nothing. They didn't do anything. They left rates unchanged. We don't care about that. Though we're not going to talk about that. We're going to talk about what's actually happening in the bond market. Relate that to the stock market. Relate that to commodities. Put it all together for you so you actually understand how to make money. Deal. Good. Jason Purrs, how are we doing today?
Good. Ready to talk about the Fed day. Always excited to talk about the Fed, what's going on, and where we're going to be at in the markets, how it's going to affect equities. That's why we're here. So let's do it.
Let's dive right in. Actually, I do like JC. I know you probably don't care, but Jason and I agree. We do like to look at the automated tool they come out with every time, where they kind of tell you what the Fed changed in their statement from last time. I think words matter.
So tell me what changed. Tell me what changed and why I should care.
I don't know if I can tell you why you should care. I'll be honest with you.
Tell them what changed. I'll try to answer, but really it's a toss up. But my favorite part about this was JC's face when we said we kind of care about this. JC made the best face ever. So you guys were watching, check that out.
Well, look, I mean, you can see exactly what changed right there. So economic activity was expanding at a moderate pace last meeting. Now it's expanding at a solid pace, right? And job gains slowed this year, and they remain low now. So, a lot of it is semantics. They're not, the messaging is still going to be the same. Although I do note the deletion of the last clause in that second paragraph there about the risk to employment rising in recent weeks, which was in the last statement and not in this one. Thought that was interesting. But yeah, I mean, I don't know, Jason, do you have thoughts on this?
So I'll just say what only thing I really care about today, and I think it's, once again, this is there's just things that change, and it's easier to me to just look at this rather than trying to dig through the whole statement like I used to do when I first started trading and never did again for many years.
Yeah.
But I think something that's going to be interesting is, because of all the political pressure, what Powell might say today could be interesting. So the Powell presser is always a little bit interesting, but it's usually boring, nothing to be said. I never really watch it. I haven't watched it in years, honestly. But it could be interesting if he kind of comes out and says a little bit more about the situation that's been happening, the amount of pressure he's been under to leave rates, make rates lower going forward, and who's going to replace him. So I think that's going to be interesting, if anything, but probably just a big nothing burger.
Well, he's live right now, but if you're watching us, that means you're not watching him. So we appreciate that.
We got more important things to talk about, because we're talking about what's actually happening. And what's actually happening is that ever since these people started lowering interest rates stopped going down. That's actually, if you go look at the data, you see, as soon as they started lowering interest rates stopped going down. Interest rates are up again today. Right? And I'm talking about the interest rates that matter to the rest of us. We're not banks, right? The Fed funds rate. What are we going to do with that? Right? We're looking
Spencer,
at 10.
hit slide 10.
Oh, slide 10. We're jumping around here. All right.
There it is. Great chart. Jason Purrs.
Got the spread there. Got the spread there. Ready to see that. That thing is making a big move. So
come on, guys.
Once again, the thing that you got to pay attention to here is everybody thinks, and this is if you talk to a mortgage banker or whatever, they're like, rates are going lower, the Fed's lowering rates. There's been many times in history that's not the way it goes. The Fed can hold rates down like they did in 2020, and then the long-term yield could start moving up, and at some point they have to follow it. Same with 2018, the 30-year yield went down, and then at some point the Fed had to follow that lower. Today, we're kind of at the point where the Fed's lowering rates and the 30-year yield is going higher. At some point, the Fed's either going to have to make a decision and go higher or not. However, they're replacing Powell, who is the person who probably would be like, yes, we just have to go higher. We have to follow the curve. But if that doesn't happen, I think we're in a really crazy liquidity cycle, which is only going to be a good tailwind for stocks.
Man, it was Ari Wald over at Oppenheimer recently, a couple weeks ago or last week, I forget, recently, and he was like, talking about rates going up for the right reasons and things like that. And like that's an interesting way to look at it. Um, you know, I just with energy doing what it's doing and potentially breaking out, I just have a hard time being convinced. And hey, I'm open-minded, being convinced that if energy is going to work and these stocks are going to be going higher, energy stocks, the rates are going with it, right? Bonds are going lower. If you're going to get a bond rally here, this whole energy thing is going to completely fade. I'm in the camp that rates are going to go higher with energy, and you're seeing it. Look at the IEF ETF. It's the 7 to 10 year, and it looks terrible.
Spencer, hit slide 17.
It's a mystery. What's on slide 17?
Oh, it's
great.
coming. It's coming.
This is great. This is perfect. Why don't you walk us through what's happening here? Because this is exactly what I'm talking about.
So right now, a lot of people have been talking about, bonds are going to rally and so on. And really and Steve brought up a good point on the show. Like, if money flows out of gold and silver, where does it flow? Some people might say bonds. Some people might say stocks. I think we're in a cyclical commodity bull market. I would say that money is going to be very similar to what happened a lot of people forget, JC, in 2020, gold topped. In August 2020, went sideways for years. It was a very frustrating trade, just like energy is right now. Then energy popped and became one of the best trades of 2021. This is the same type of situation where gold's been a great trade. It's been moving. Maybe it tops out, maybe it doesn't. However, if money's going to flow anywhere, I think it's going to flow into the energy sector. And also that's going to go with bonds. If we see energy moving higher and oil moving higher, that's inflationary. And the bond market always follows inflation. So if energy stocks go higher, TLT is breaking down. And I'm waiting to see that confirmation there. So I agree with you.
Yeah, and I try to think about what types of stocks, what does that mean for the stock market, right? So great, energy stocks are doing well. Do energy stocks doing well, is that at a cost for the rest of the market? Like we saw a few years back when energy stocks were doing so well, and there were really some of the few stocks that actually were doing well in that period, like 3-4 years ago, right? Does it have to be that, or it could be like an 07 where energy stocks are doing well, and there's other cyclicals and other stocks doing well in that environment as well?
I think we're heading into more of a 2021 period, if anything, right, JC? So we're kind of heading into 21 where we're kind of energy might be the outperformer. Some of the metals, mining, and so on might do well. International will do well, and so on. And maybe the stock market just does okay behind it. I think that's kind of the scenario we're seeing. At some point, that inflationary pressure will put a lot of pressure on the market, but I don't think we're anywhere near there yet. I would say you want to get oil back above 100 to even be having that conversation. We're far from it at the moment. So I do think it's a rising tide lifts all boats. Currently, probably cyclicals, energy, and international probably leading the way. And then at some point, when you see energy is just really ripping, that's probably a really bad signal. You see energy leading the way. Let's say technology is going down. That's probably a signal to say, hey, we're kind of moving to the downside here, probably in the stock market at some point.
I was going to say, can we talk about the dollar for a second?
You took the words right out of my mouth.
Well, I want to start here. I want to start on side 11.
Shout out Meatloaf.
So there's a lot going on here.
What?
This is a Rick chart, which is, I thought it was pretty interesting. Rick kind of pulled this one out, and I was like, yeah, this is very cyclical to the dollar cycles, and kind of like us getting out of that quantitative tightening. Basically, we were in that point where we started aggressively raising rates after 2021. That started moving higher, and then the dollar kind of ripped. And then remember, JC, and I know you traded this as well, that October bottom in 2022. So the October bottom happens in 2022. We get back into more of a liquidity cycle, and the dollar's basically been moving down with some small rallies here and there. So I think that's probably going to continue as long as the Fed is holding rates down in any which way. I think that cycle is going to continue.
And I want to reiterate, we're here talking about the Fed and, kind of like the decisions and everything like that. And the truth of the matter is, we're way, and I can speak for myself, but I'm way, way more interested in how the market is reacting to all of this versus what a guy has to say about it, or, what changed, in the speech or whatever, the red line. I'm more interested in what the market is doing, right? So the dollar is a huge implication here. You know, these Forex markets and these bond markets are really the big players in this global market landscape. And the stock market is a smaller player compared to all of these, right? So even if you don't trade Forex markets, I don't now. Even if you don't trade futures markets, I don't trade futures. Jason does. I don't trade futures. I bring it back to equities, right? And options on those equities, and understanding the role that the dollar is playing in driving these risk assets, particularly metals and stocks around the world. I don't know if you noticed, while the dollar's getting slammed, all these things are doing well. That has a major, major impact on the stocks that I'm trading and looking to trade. We've been in these stocks, these foreign stocks, precious metal stocks. Why have we been long? Because of the weaker dollar, right? Like, I mean, that was a big, big reason why we were focused there. We were talking about it a year ago, of course. And so you saw it. So now that we're talking about interest rates, we're talking about the FOMC, what that means for the rates. You're seeing what the 30-year yields are doing. Interest rates have been going up ever since they started cutting interest rates, which is hilarious, right? What does that mean for stocks? And, you know, I think that the dollar here is a big one because we just made new lows, recovering today, big recovery today on the dollar. So what stands out to me most from this, you know, post FOMC sort of situation? Dollar's ripping. A lot of these Forex markets are getting slammed pretty hard.
Yeah, I think that's going to be the biggest thing people should keep an eye out is the dollar. You know, we get above that 100. To me, it's 101 to make it like I usually like to go a little bit above where it's at. Above 101, we're probably into some major headwinds for the stock market. As long as we're kind of chopping around or moving lower, I think we're going to continue to see this move into the cyclicals, into value, into energy, into even regional banks, even some small caps, micro caps. Like these are all really moving nicely. And I think that's going to continue as long as the dollar continues to move lower. It's a Fed day, guys. Something that was taught to me early on, which is if you're trading a Fed day, understand the day of the Fed day, there's going to be a move and it might not even last. The next day, it's the market digesting that move. Friday, we kind of get some normalcy. We'll start to see what direction the market's really moving based on the close for that day. But for now, it's like the dollar's bouncing. Pay attention to that. Let's see if it can really close above this 96 level. And then let's see what it does on Friday going into next week.
Just understand that the really interesting scenario that's going on right now post FOMC, speaking of things not being able to last, you're seeing gold and the dollar both ripping at the same time, which is really interesting. I don't think that's sustainable. Silver's making new highs. Gold's making new highs literally as we speak. You know, serious gold prices. I mean, you're looking at gold at 53.40. 53.40, dude. And you're looking at silver at just under 114. And then you got the dollar index really moving as well. Up a ton too. So I don't think that's sustainable in my humble opinion. Gold and the dollar ripping together for too long, Jason, right? You can make that bet.
So JC, as a trader, you know, how do you look at that? If you're looking at gold, the dollar, and silver, what's the primary indicator to tell you which way you would go with this one?
I mean, I think one of them's got to make up their mind, you know, like Yogi Berra said, when you hit a fork in the road, take it, right? So I mean, it's got to. This can't last forever.
Yeah.
Gold and the dollar moving together. Yeah, I don't think so. We'll see what happens there. But some of these other forex markets are really taking it in the chin, right? Money's got to be going out of somewhere. If it's going into, it's got, you know, it's going out of yen. Yen's getting clobbered. Euro's getting clobbered.
Oh yeah. I mean, I think it could be a scenario where, like, most of the time for me, I'm always going to take the primary trend. You know, if we're looking at the primary trend of things, you know, look at that primary trend of gold versus commodities. That's an easy one to start with. That's a huge move higher, looks great. You know, I'm going to still bet in the way of the primary trend. The dollar is in a nasty downtrend. I'm not going to try to buy that low. But if you look at the bottom of this chart, this is bonds versus commodities. That's been chopping around for a long time. A lot of people are like, man, bonds look terrible. Man, commodities look terrible. But the primary trend has been commodities over bonds for a long time. Now we're actually seeing the breakdown. This thing's been coiling for a long time. Now we're finally breaking to the downside, meaning that oil move might be very sustainable. The energy move might be very sustainable. So I'm still thinking here energy over bonds for sure. I'm still thinking gold definitely over most of the commodities for the moment. But I think that's going to shift. I think we're going to see money continue to shift into the energy sector and some of these base metals, and then possibly some money comes out of gold. Don't think it's crashing anytime soon. Don't think anything's wrong with the gold trade at the moment, but just saying that's something I want to keep on my radar for Q1, Q2 this year.
Man, this bond breaking down. Go back to that. Go back to that chart. Go back. Bonds breaking down there relative to commodities down at the bottom. I mean, these are major implications. So when you talk about the selling that we've seen in bonds, when you talk about the appreciation you've already seen in a lot of commodities, although that index there will be more energy driven for sure, you know, man, bonds down, energy up. That's the way I like to, that's the way I like it. Right? That's how I like it. Right.
No, I think that look, man, you and I have been talking about, well, once we talked about last year, the dollar topping out, right when it topped out, that was the beginning of 2025. You and I would get on and talk about the commercial positioning. Basically, the smart money started selling the hell out of it. The dumb money's continuing to buy it to a crazy level. And next thing you know, that thing tops out and rolls over. That thing's been in a downtrend for a long time. The bond market's been saying it. There's liquidity coming in the market. So the dollar's getting very weak. And then now we're finally seeing that next scenario where we're seeing the energy stocks start to pick up. You and I last year, same things, crack spread starting to widen. We started to see the refiners start to outperform. We've seen basically everything we want to see energy start to move. And then to start this year to date, where are fund managers? Where are allocators? Where are they all putting their capital? A lot of them seem to be putting it in energy stocks. So energy and materials are the best performing sectors in 2026 out of the spider sectors. So that's looking really good. Yep.
Double digits.
Yep. So those are looking really good. So I think that, stock wise, you just want to know where to position yourself. And that's the thing I love about All-Star Charts is that we kind of always look at things like, we don't care if we're in China, we're in Japan, we're in Africa, we're in South America, and so on. We will be anywhere where money is being made. And also we trade every sector. So, some of us will be in energy stocks, some of us will be in international energy stocks, and so on. Like, this is how you trade. This is how you make the most money. And that's what we do well here for our clients.
No, well said. What about slide 2 there? So you know how I feel about these magazine covers, Jason. You know, you're Mr. Futures expert, CTA over here, but you know how I get down. I get down and dirty, right? I go in there, I count, I study the history. I know what this history is like. And I was smelling. I was like, man, you're getting a crude oil magazine cover any minute. By the way, I'm smelling the gold magazine cover now coming any minute.
It's coming.
Oh, yeah. Silver. Boy, is it coming. I could tell you right now. So then I had a hunch there was an oil one coming. Sure enough, there it is. Cover the New Yorker. Chubby Donald Trump, chugging right out of the oil barrel. Man, right down there at the bottom. Come on. You think that's a coincidence, or you think this plays?
I think that was it's the best time. Like, for me, it still goes back to the Venezuela situation. That was the best timing I've ever seen in my life to go, holy shit, that's the biggest news failure event I've ever seen in my life.
Yeah, because in theory, we have all this access to all this oil. There's plenty. Oil's going to be cheap forever. That's when you buy oil, because it ain't. Yep.
Well, you had the last year.
Right? Is that right? Do I have that assessment right?
Yes, absolutely. But last year, if you look at it too, we look at every time he said, I want oil or gasoline at $2, he would say this, and then the oil price would get smashed over and over again. Everything in the energy sector would get smashed. And then, once again, we get to the biggest event that he's ever had. And he's like, okay, we're taking over Venezuela. Oil's going to be super cheap. Let's see how this goes. And then, boom, it bottoms out right there. And actually, oil was up that day, which tells me a lot. No, this chart's another great one.
Reminds me of this one. Drowning in oil. Drowning in oil. This was right there, right back in 99. Right
oil single digits, right? Oil under $10. Yep.
Good. Come on. This one up 14x from there. Come on. So when I see, Trump drowning in oil, I remember, I'm like, you know what? I've seen this before. This is very familiar. This is actually one of the few legendary magazine covers that I don't own. I don't have this one. It's tough to get.
I love this, man, because it's always the biggest contrarian indicators always happen near the bottoms. And also it makes a lot of people, like, once again, we talk about Venezuela. You were on with me on the show, the morning show, the day I got on and said, hey, I'm going to buy oil today. So basically everybody's like, that's ridiculous. It's stupid. That's when sentiment is really at that bottom. And we've been looking for that bottom in oil and energy for a long time. We have not seen it for a long time. Today, we're there. I think we're there. I think this is the time when energy stocks start to move.
I'd like to bring it back to the stocks, right?
Let's do it.
I like to bring it back to stocks and the stock market. You know me, I'm not like Mr. S&P 500. If it breaks this, it's going to go higher. What's that? Spencer's on mute. We lost you, Spencer.
Sorry. I said, oh, we know you're not Mr. S&P 500. Yeah, we know.
Yeah, like I'm not like, and then earlier in my career, I would say 15 years ago probably or more, I was really focused on the S&P 500 and these levels. And, I was really that guy. But, I've learned over the years, mostly the hard way, that it's a market of stocks, which is why I look at everything else. And I value, the rest of the stuff, not just this. But I got to tell you, these are some pretty big levels, right? These are some pretty big levels for the S&P 500. These are the Fibonacci extensions from the decline last year. Can you throw up, zoom out, throw the next one up, Spencer. This is the long-term view. So if you zoom out, and you throw up the Fibonacci extension levels from the 21 highs, right? It matches up. So when these levels cluster together, it's so important. So this 7,000 level, like, yes, psychologically 7,000 is a big round number, but I got to tell you, there's a lot more going on than just 7,000 being a big round number. So if the S&P is above 7,000 and you're shorting it, I think you're crazy. I think it's incredibly bullish, but it goes both ways. This is a logical place for uptrends to fail and stall out, right? So that's my point is if it doesn't, the bullish implications are off the charts. You're going to see 8,000 real quick, I think. So this is a big level how this resolves. You start seeing this back below, 6,800, 6,700. You're down there. That could start to be a bigger problem. Above 7,000, man, it's a go. And then when you look at the NASDAQ, throw up the next one. When you look at the NASDAQ, you see kind of like a similar situation. The Fibonacci extensions clustering right there. So both of these, right there, S&P 500 did close at a new all-time high yesterday. See how it shakes out for the week and the month for that matter. We get new monthly candles at the end of the week. So very much looking forward to that. So keep on that. That's what's on my radar. And here's the last one. Throw up the technology relative. So I look at semiconductors as a leading indicator for technology, right? Because I've gone back, I've looked. It is, right? So if semis are doing one thing, if I'm trying to make a decision on technology, those semis are going to have a heavy weighting on my decision making there, right? So here are semiconductors relative to the S&P 500 hitting new all-time highs right now. Let's see, double check. Literally, is on pace to close at a new all-time high today. So my question to you, Jason, what sense does it make to bet that the black line isn't going to do what the blue line's already doing?
I mean, the semis have been so strong, JC. Semis have been so strong. It's an area that I've still been long. I feel like I've been long semiconductors forever at this point. It's probably since January 2023. So they look really good. Nothing to do there. But some of the Mag 7 names are looking a lot weaker. And the XLK, if we're looking at that, that's really a lot of Apple, a lot of Microsoft. NVIDIA is in there. But if we kind of get this, rally in semiconductors, I can't really see technology not going with it, right? Like that's a scenario where we'd go, okay, well, technology has to probably go with this one. But once again, we're looking at semis. I just want to play it one trade at a time. I want to stay long semis. Maybe technology is a little long in the tooth at the moment, but I'm going to stay long semiconductors no matter what here. That's what I'm doing in my portfolio, at least. And software looks bad too. Software doesn't look good.
Yeah, bringing it back to interest rates, considering it is a Fed day, I'm more of an equities guy. Jason is, futures and will trade anything, so it's a little bit different. I guess I'm a stock and crypto guy. Stock crypto options is where I live.
Oh, you trade everything, JC. You trade everything.
Yeah, but I don't really trade futures or Forex these days. I mean, I would, I guess.
But you trade the ETFs on different commodities. You trade the ETFs on bonds.
Right. I'll trade options and ETFs mostly if I'm going to be in those commodities. But generally, if I'm going to be in the commodities, I'm probably going to be in a stock in the commodities also. Anyway, that's nor here nor there. Bringing it back to interest rates. Interest rates, as I mentioned before, stopped going down as soon as the Fed started lowering interest rates, which is hilarious. And so as interest rates are going up, and we're talking about potential rotation into technology, does it make sense from an intermarket perspective, Jason, of technology outperforming in a rise with rising rates? Does that make sense, or is that?
Great question. Look, here's the thing. A couple years ago, and you know this, JC, because we had this conversation years ago, which is if you're in 2023, you're in this rising rate style environment, even 21, all this rising rate style environment. But what did technology do? Everybody was like, well, the PE ratios, all this stuff, all these fundamental stuff I could care less about. But they would say, okay, this is all going to go to crap because yields moving up is going to put so much pressure on technology, and they're so overvalued that they're all going to crash.
Long duration, right?
Yes, yes, long duration, blah, blah. It's all going to crash. And then in reality, the answer was no, technology shrugged that all off and continued to move higher. So I don't really want to bet one way or the other based on the interest rates. I want to do exactly what you would do, just what I do, which is ride those trends. If it's in an uptrend, I'm going to stay long. I'm not going to overthink it. But I do think rising rates to a certain level will probably get to a point where technology stops moving, but also I think most of the stock market will start underperforming at that point as well. So now I'm still all systems go. I'm still long.
So you wouldn't be surprised if those historical relationships continue to exist, but then you also wouldn't overthink it and hang your hat on that.
Absolutely.
Right? Yeah. Okay.
Well
Fair
said.
enough. A few minutes ago, someone in the chat made a comment. Doesn't earnings matter more this week than the Fed? I forget who said that, but whoever it was, I think you're right, actually.
Probably, right? Probably.
Yeah. I would agree with you. So with that in mind, if you haven't yet signed up for our special earnings training tomorrow with Steve Straza, you should do that. He's going live tomorrow at 2:00 Eastern. The link is on the screen right now. He's going to show you how he trades around earnings season. He looks at past reports. He looks at reports that are just out. He looks at charts. He puts it all together to actually trade earnings the right way, profitably, not just obsessing over do they beat or do they miss. It's not just about that. It's about the beating or the missing of the estimates in the context of the chart, in the context of the market's reaction to the report that was just out, to last quarter, to the quarter before that, the quarter before that. And he's going to go through all of this tomorrow at 2:00. Use that link on the screen and be there. It's going to be a at the very least a profitable experience. I can
I've
promise
watched
you that.
him build it. I've had a front row seat to this, and it's a lot of man hours and a lot of technology, and it's really, really, really cool.
Yep.
Yeah.
All right.
Good stuff.
This was fun. I guess we'll do this again. Jason, when's the next meeting? Do you know? I don't even know.
What is it? Every 6 weeks?
Something like that.
Every
8
6
times
weeks.
a year?
Yep. No, JC's on it more than I am. Yeah. I don't know.
Come on now.
I just look at the calendar.
Listen, whenever the Fed's gonna speak, if you could ignore that and go watch some real analysis of what's actually taking place instead of all this theoretical bullshit, we'll do our best to be right here and break it down for you.
Absolutely.
All right. On that note, we're going to get out of here. Thank you for watching. Drop us a like, and we'll see you tomorrow morning on the morning show. All right.
Nice. It's a bunch of malarkey, right? Isn't that what Strauss says? A bunch of malarkey.
It is. It's all BS, but we're here and having fun. Love to have these sessions with you guys. Thanks, Spencer. Thanks, JC. We'll see you guys soon.
Adios.